is just a couple of really great tools that are out there, free tools that I think, are useful to use, especially as you are developing your thesis when and if you want to get into a particular trade, and what the actual seasonality and historical data is demonstrating to you from that information about the movement of the underlying, I should say.
But before we get started, the disclaimer. You have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than the investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. And again, these videos are for educational purposes only. You must do your own due diligence and research before setting up any of these strategies in your live account. But please do practice them in your sim account immediately so that you can start to get used to how each of these strategies work as there are changes in the market throughout the day.
One of the things that oftentimes I think goes missing when people are looking at seasonality is that stock charts actually will derive the absolute percentage regarding the move up or down of any underlying that you are looking at, and they will derive that information from the number of years that you historically want to look back at. So you can change the number down here so it only looks at maybe like 3 or 4 years, so that you are looking more accurately at the season of Corona. However, if you are working with an underlying that has been really consistent over the last, let's say like 10 years, like a Google, then you might want to have more years of data to look at. And of course, you can just adjust the number here and look at what does my underlying look at if I don't know why it's not allowing me to change this. Yeah, if I reduce the number of years or expand the number of years. And so I think this is a really great piece of information to look at. Now, the number on top is showing you in percentages how often the end of the month closes higher than the month before. So the percentage at the top actually is only showing you, the underlying could literally have closed 1 cent above the opening, and it would be that during that month it opened higher 100% of the time. But that would not be a very interesting investment. I wouldn't want to buy an option or shares in a company that is literally going to move just sideways to slightly bullish. I want to see that it is moving, that consistently during a period it's moving, and it's actually moving up in a very significantly bullish or bearish way. And so this could actually give you a lot of, help you develop your thesis, whether you want to sell credit spreads above or below the price movement, or if you actually want to go long a call or long a put, because you're able to evaluate what is the likelihood of the underlying actually making a significant price move. And these are percentages. So it would be, here it says 5.6, so it would be 5.6% move of the underlying. And right now, one underlying that a lot of people are talking about is home buyers, or home builders, I should say. And so if we go to the home builders, so this is for the S&P, that's where we were. So the S&P, the sector for home builders, this is what the performance is looking like. And right now, and even though historically December is a lower month for activity or a flat month, actually home builders is doing really well. And so if we look over the last years and we just evaluate in these 3 months, let's say that you bought at the beginning of November and you held it all the way till the end of January, you would have achieved almost a almost like a 14% move, or sorry, 13.5% move. That is a significant move, to be honest. So that would give me, that would give me kind of motivation to sit, to actually stay in a trade, even if December maybe acts a bit flat, but actually considering how bullish November and January are, I would I would prefer to stay in the trade, because sometimes you don't time your exit and entry perfectly, and so you end up getting this slippage for no reason. So this might actually have given me a sense that, I could actually get in at the beginning of November and stay in through January. But of course, now it's December. And the great thing is that December is usually an underperforming time for home builders. So based on that information, I might actually say, getting in, looking for a breakout or looking for some kind of, pullback, because right now home builders is doing really well. Let's actually look at it on the chart. So right now it's doing pretty well. And on the RSI, it's getting close to overbought, but not really. So I might just put on, let's say, an indicator. I might put on an EMA, and really I want to see the bigger EMAs. So I don't want to see too, so, I might say a pullback to the 20, but even a 20 is quite far away. So it might not pull back that far on the daily. Let me clear that drawing so I can go to visibility here. It's actually not letting me adjust it. So never mind. So, I might look and say, okay, if it pulls back to the 20, then I can get in here and then write it out to January. But right now we have a bit of a gap up. We had a strong gap up, just like the rest of the market. So that might have been it. This tap down on Friday back to the top of the gap might be it. And now we're ready for a run. Buying volume is actually looking decent. We're not overbought on the RSI, but we are in positive territory. So all the EMAs are stacked positively, which is great. So we might not really get a strong pullback, but this isn't necessarily a recommendation, but this is kind of the thought process somebody might want to go through while they're looking at the charts. The other thing, you might want to go back and just see what did last year look like just around the same time. And let's see, we are in about the 14th day of trading. So really, if we look around here, see how it comes up and then it comes back, it pulls back at the beginning of January. And that's why January achieves this huge run up. So it seems that, maybe right now we're in this run up period, and then it'll pull back to it pulled back to not just the 20, but it actually pulled back to the 50 on options expiration date. And then it had a really nice run up. So I might, put this on my watch list and say, okay, this has a really great run up during the month of January. And I am, this might be a good trade. But I just want you to see that, you don't have to do all of the analysis all of the mathematics in your head. You can do a lot of the mathematics really quickly by trying to figure out, okay, how many years do I want to evaluate, and then change the number of years down here. And it's just in case stockcharts.com, and you can you just change a chart here to, here it's on, you want to change it to seasonality, but I was already on seasonality, that's why. But up here, when you first come to stockcharts.com, just changes to seasonality. And then all of this information, you can look on anything. We could look at Google. And so, a company like Google that has been around for a really long time, and probably their entire business strategy and so forth isn't, completely changed because of COVID. I mean, we do know that people are likely, accessing more what's the word that I'm looking for, using their computers more because of COVID, working from home, so forth. So I might say like, oh, I want to see, has Google actually done better in recent years? So, looking at 3 years, December was great, was okay. But January is the month for Google, right? If I look back 6 years, it's still a really strong month. If I look back 8, 10, 9 years, January continues to be a strong month. But the question is, how much strength does it have? And so that's where it's really key to look at the absolute percentage down at the bottom, because, at 89%, if I look back 9 years, almost 90% of the time, January closes higher than it starts. But in absolute percentages, that's 5.1%. And then if I actually look back at the rest of the year, besides July, if I add July and January together, that's like a almost 13.1% move. And the rest of the year, okay, October is another good month, but the rest of the year, it's actually quite low, even negative. And so if you are trying to outperform the S&P, if that's your goal, that as an individual trader, you are trying to outperform the S&P, this is how you have to do your analysis, because you don't really want to be getting into trades that are not moving. And you don't want to get into trades that historically are not strong. So your only thesis is just like what you are looking at this particular minute. And so in order to really up the ante, or the percentage at which you are outperforming the S&P consistently, is by utilizing some of this historical data. But you do want to look like at a range of information. So it's not just like, oh, it opens up at 5% and that's it. You want to move the data around, see what did it do the last couple years, what has it done over the last decade, and then look for those percentages to see what is the actual move, and then see how are the charts lining up this year based on that historical data. There's another chart that I would like to show you. So one of the things that we often talk about is, we talk about particular months having a rally. And the problem is that because not every month has the same number of trading days in the futures market, every month doesn't have the same exact number of days. So the number of trading days is sometimes a bit off. So there is a trader, a very famous trader, his name is Larry Williams. He teaches his students that when they trade, they should always trade based on the number of trading days. So the first to the whatever, if the month is normally like 30 days, the first, trading days of the futures market, and then looking backwards and forwards. So let's say from like on the 4th day, from the first day, the market usually does X historically, or from 4 days before the end of the trading period of that month, the market usually does X. And the reason that futures traders talk like that is because of the fact that their contracts don't have theta. Their contracts are on a 3-month rolling period. And so the question about the movement of an underlying is going to be based on when that options expiration comes, or the futures contract rollover, I should say, when that is coming. So when he is testing his strategies, he's testing them on the ES or the NQ, which would be the S&P and the NASDAQ, but in the futures market. So they obviously have a basically 24/7 trading model. It's not really, it's 6 days of trading, but it trades consistently around the world. So there's kind of this, it's a different kind of volume mechanism. But what it does allow you to see is how much positive movement is happening, not just in a particular month, but at a very particular period in the month. And so the whole Christmas rally conversation that started coming up was based on what was happening on, oftentimes people are looking at the SPX or NDX, or the S&P and the NASDAQ. But he is actually looking at the futures market, seeing where the most significant price movement is. And so based on his analysis, it's really the last 5 trading days in December where you achieve the greatest rate of return. If you were to enter a trade, and basically you just set a wide max loss. So here he entered at a crossover point in the EMAs and the RSI. And as most futures traders do, those are 2 key indicators that they utilize, is the EMAs and RSI. And when they get the right like pullback and then crossover that there's going to be a positive momentum, then he would enter the trade, and then he would put a max loss at $2,500 behind. And so on each of the trades, the question is, how many winning trades did he have against losses? And basically the lowest times that he had losses were 5 days before the end of the month. So there were 4 trading days left in the month, 5 trading days left in the month, and there's another 1 right here, which was 7 trading days before the end of the month. So you can just screenshot this. I mean, it's going to be up here for you guys to look at again and to analyze, and you can look at all the details. But I really appreciate how Larry Williams does the analysis, because he is utilizing not just the quote unquote, the opening price of the VIX, or in the overnight, the SPX, the futures markets, that the overnight on the futures markets were down, or the ES opened down. Because part of that problem is that really, even in the US markets, there's so much volume in the first trading hour of the day and the last trading hour of the day, because those are the 2 trading hours that generally banks and hedge funds and big institutions are actually trading in the day. They don't often trade throughout the day, but usually they're going to start positioning themselves, especially in relation to the futures market, in that, well, actually in the futures market, it usually starts at 8 a.m. that you start to see that morning volume pump in the US markets. So sometimes the information that a market is opening down is not the best or the most useful information, because if you are analyzing it based on a very low volume period, then that's unhelpful. What is really important is to see what happened at the opening hour of the Asian market, the opening hour of the European market, and 8 a.m. in the US markets, because that is where you will see big institutions entering or exiting in order to balance their options trading deltas. So I've said a lot. You might want to listen to this again, but since you can listen to it again, I don't want to make it longer than necessary. But I do find the trading style very useful. And the fact that the information he is giving us is based on from the last trading day of the month in the futures market. So that could be a Saturday. And then when you actually look at the calendar, what that allows you to do then is to find, okay, 4 days before the last trading day. So the 4th of the last day is when, in relationship to the normal calendar, and then looking back at that then comparing it to your options trading. So for those who are not, well, even if you're trading the SPX, you have to do that with options, even if you generally trade shares on your equities. But if you are trading the indexes and you want to follow this strategy, you would probably want to look at how the ES correlates and the NASDAQ correlate to what you are trading in your options. So I hope that is a little bit helpful. Hope that was not confusing. I probably could have just opened a chart to see that the last trading day of December is on a Friday. So the best So if I look back, 1, 2, 3, 4, Tuesday the 28th is the best. Then the 27th of December is another really great entry. And then 7 trading days. And then Friday the 24th, but I don't know, that might be a bank holiday. I'm not sure if in the US you guys have a bank holiday on the 24th. So that 7th day could be actually the 23rd. And basically that's the lead up to Christmas. So it's like the last trading day before the Christmas holiday. And then the days immediately after are the strongest move of the NASDAQ and the ES in December. So this is why we call it the Santa Claus rally, because these days are actually perfectly surrounding Christmas and St. Stephen's Day or Boxing Day. In the US, I don't think it's widely celebrated, but throughout Europe and Asia and Africa, Boxing Day or the day after Christmas, St. Stephen's Day is also a public holiday. So anyways, so basically it's the days before Christmas and the days following the Christmas holiday where we will see historically what has been the biggest move in the S&P and the NASDAQ. So I just thought you might find this kind of information relating to seasonality helpful in your own analysis as you are deciding what you would like to trade going into the end of the year and how you want to evaluate your performance against something like the S&P. All right, bye for now. And thank you guys for joining us at the Jade Lizard Trade Speakeasy. Bye for now.